Good morning. Thanks so much for attending today. Sorry, we had some technical difficulties getting things launched. We've actually been doing this webinar or doing classes for the last 5 years in person, but this is our first webinar experience. So it appears that it's a little bit of a learning experience. So we're very excited to have everyone here, and we think we have a lot of good insights to share. We'll be doing this monthly webinar going forward on a, hopefully every single month on different topics, everything from Social Security to Medicare. Today, we're talking about the market and giving you a market update. I'm Josh Goulding. You should see two panelists with me, my partners, Jeff Cicillo and Jamie Hamilton. Jennifer Hutton, unfortunately, was not able to join us, but we're very excited to start. So a couple things before we start. You should have the ability at the bottom of your screen to ask questions on the Q&A box. If you type in those questions, we will see it, and we will address those questions at the end of the presentation. So our first slide here zooms out and takes a look at the market history going all the way back to 1900. As you can see from this graph, I think one of the most important things to see is just how many periods of expansion and contraction there are over the past 100 years. And to give you some perspective as to the level of compounding wealth over time, if you invested about $8 back in 1900, that $8 would be worth more than $1,000 today. There would be lots of periods of volatility. And in fact, you can see the most profound market contraction occurred between 1929 and 1939 with the Great Depression, where the S&P 500 dropped between 85 and 90%. So to put that in comparison, during March, from the peak in February through to March 23rd, when the market hit a low, the market contracted about 34%. So significantly worse then. Another interesting thing to note when we look over the past 100 years of the US markets and economy is the gray bars. The gray bars indicate periods of recession in the US. And you can see from 1900 to really the start of World War II, the recessions were much more frequent and longer in duration compared to really 1982 and on. You still had duration, you still had recessions, but they were not nearly as long and less and lower in frequency. So we're going to come back to this, but I wanted to actually start with a quote as it relates to just the big picture when it comes to progress and crises. And it's by a gentleman by the name of Morgan Housel. And it says, "Progress happens too slowly for people to notice. Setbacks happen too fast for people to ignore." And I think that's a really important thing to keep in mind, is we've had, profound wealth creation in the stock market over the last 100+ years. But when people think about back in terms of history, they think about World War I, World War II, Vietnam, a period of stagflation in the 70s, and most recently the tech bust, the global financial crisis, and now coronavirus. So when we look at stock market, if we kind of zoom in on the period, the last several years, and highlight what's happened in the last several months, I think it paints a pretty clear picture. What you see here are 3 lines measuring the S&P 500 performance over different time periods. The green line shows the market, the S&P 500's performance going back to January of 17. And it wasn't without volatility. A lot of people forget that in the last quarter of 2018, the trade war started with China, tariffs went into place. The market actually declined almost 20% during that time period. And if you fast forward, you can see the sell-off that started in late February and how quickly and sharply stocks fell. And what's interesting is we've had a very profound recovery. And if we look from January 1st of 17 to June 15th, which is about where the market is today, you can see that stocks are up 35.8%, which equals about 9% annualized return, which is very similar to the long-term average. The blue line shows the performance from January of 18 through current date, and the performance there has been 13.8%, still quite good. But if you were to measure your performance from the bottom of the coronavirus sell-off on March 23rd, you would see from January of 18 to that point, stocks were down 15%. And then the red line shows the performance from the peak. So it shows the performance since about February 20th, when the market hit its last peak, to where we are today. And miraculously, despite unemployment at its highest level since the Great Depression, the stock market is only about 10% off of its highest level ever reached. So now for a look at some of the economic fundamentals. One of the things that has been very surprising to us at 4J is the disconnect between what's happening in the market and the underlying economic fundamentals. As you can see here, this goes all the way back to 1970. And what the gray line shows is the unemployment rate over that period of time. And you can see in 1975, when there was a recession, 82 was a recession, and most recently in 2009, the unemployment rate hit 10%, 82 it hit 10.8%. In May of 2020, unemployment rate hit 13.3%. And if we factor in the underemployment rate, which is people who were furloughed, people who are now working part-time as a result of the shutdowns, what you'll see there is it's probably closer to 20%. Another, I think, really important point to note about this slide, and it's, you're seeing more and more of this being talked about in politics, and even companies coming out and starting to invest money in this disparity, is from the period of 1982 to basically 2020, look at the wage growth, right? Wage growth really hovered in the 2 to 4% range for a long, long time, and still is in that range. And what that means is that the people's wages are not keeping pace or really outpacing inflation. And what most recently happened in May of 2020 is a lot of the lower end of the workforce, the people who make the least amount of money, those were the people who were laid off. And so what you see is that the actual wage growth increased year over year in May of 2020, because the people that were left were the highest income earners. So that top 1%, top 5% have gained a much more significant portion of the wage growth over the last 40 years than the other 99, 95%. And that's why you're seeing talks of universal income and things of that nature become more commonplace. And we think that trend is actually going to continue in light of coronavirus. So coronavirus, COVID. This is a good slide that shows, as of June 24, 2020, there are now 2.3+ million confirmed cases in the United States. This was the reason for the sell-off initially, was the uncertainty around what was going to happen as a result of the spread of coronavirus and the economic shutdown that was going to happen as a result of that. And sadly, there's been, I think, over 500,000 fatalities throughout the world. In the US, north of 120,000 people have passed away. On the right side, and this is the first data point of why we think the market has started to turn at the end of March, was the number of confirmed cases per day peaked in late March, early April. It has trended downwards for the last several months. As states are reopening, that is starting to pick back up. And of course, more widespread testing. But one of the good data points that we're looking at is the continued decline in the number of fatalities so far. But what the market does, it's very odd. People, they feel like the market's going up, but the world looks so bad. A lot of what the market looks at is trends and data, right? It's trying to forecast the future, not just look at the past. So even though the data was bad, it was actually getting less bad. And so when the data gets less bad, the market actually will respond quite positively to that in most situations. That was one of the factors, we think. The second big factor as to what drove the market so quickly up was that Congress came out and passed a very significant tax bill. Not tax bill, the CARES Act bill. A fiscal stimulus amount of 12% of GDP. That equated to about $2.4 trillion, where they sent money out to industries and people who needed it most. So this shows the breakdown on the left side of where that money went. And you can see 293 billion with a B went to just checks that went to individuals. 268 billion boosted unemployment benefits very significantly, adding $600 per week to every check until July 31st. We have every anticipation that program is actually going to extend beyond that point once policymakers realize that we haven't progressed as much as we would have hoped. And then the PPP loans, almost 800 billion in loans that went to small business to keep people on payroll, continue to pay rent and utilities. You know, the Congress acted very quickly to get this money out. And we actually think that this is going to change the future of expectations of what Congress is going to do during crisis situations going forward, because now people have an expectation of, you know, money can be sent out and things can be done. And so it's going to be expected. And because politicians need to want to continue to get reelected, they will do whatever they have to do to continue to keep this pipeline going. That could transform into, you know, universal basic income, et cetera. But we'll come back to that later. The other thing we need to mention, of course, and I think a lot of our clients have asked us about this, is, okay, the money's going out, that's helping the economy, but we're just adding to our debt deficit, we're adding to our debt. In 2020, it's estimated that our deficit will reach negative 18%, which is the highest level in any sort of recent history, probably going back to World War II. And JP Morgan anticipates going into 2021, the deficit will be equally significant. So this is from Indeed.com. It's the highest frequency or highest visited job site in the United States. And this just shows the gravity of the situation. The green and red line show the number of job postings on Indeed.com in 2018 and 19. And as you can see in 2020, we're down approximately 30% in terms of the number of job postings. So businesses are just, they're wanting to see what's going to happen in terms of the reopenings and the spread of the virus before they commit to hiring more people. So the second piece of the equation, a third piece of the equation, arguably the most significant, is the actions of the Fed. And this is, Jerome Powell acted out of the playbook of Ben Bernanke. He acted very, very quickly. Across the board, overnight, the Fed dropped the federal funds target rate. You can see there from about 1.5% to 0. Most recently in his congressional testimony, he said rates are going to stay very, very low for a long time, because he thinks they think the economy is going to take several years to recover. In addition to this, they provided huge liquidity to the financial markets by pledging to buy treasury securities, corporate bonds, municipal bonds, and even lending money directly to industries. So, I mean, the Fed has essentially pledged unlimited liquidity to the financial markets, which goes a long way to boosting financial assets, right? Interest rates are low. People have the ability to take on credit. Mortgage rates, as we're going to look here, are at 30-year lows. All of that helps to spur economic activity. And that, coupled with the fiscal stimulus that was injected into the economy, we think are the two biggest reasons why the market has come back the way it has. Of course, the consequence of that is the Federal Reserve's balance sheet has ballooned. Going back to 2008, you can see, at the time, what seemed unprecedented, QE1, you can look there, the Fed increased its balance sheet by a little over $1 trillion. The quantitative easing continued basically for 8 years until QE3 ended in around 2015. The total increase over that time frame was 6.3 trillion with a T, which is just a massive amount of money was sent into the system. Now go fast forward to 2020, and you can see in about a month, the Fed added a little over $3 trillion to its balance sheet. So we expect that trend to also continue as we work our way through the recovery from coronavirus. As you can see here, this is 30-year fixed rate mortgages going back to 1990. as high as 10%, north of 10% back in 1990. They dropped significantly back in 2008, 2009 during the financial crisis. And then just recently, after the Fed's most recent actions, 30-year fixed rates, as you can see there on the bottom right, are at 3.2%. We've had clients get as low as actually 3% over a 30-year time period. So pretty amazing. If you're looking to buy a home or are looking at refinancing, now is a pretty opportunistic time to do so because of where mortgage rates are. This is a slide that looks at individual income tax rates. And it's as high as we feel like taxes are today. If you go back to World War II through to 1980, you can see the blue line there shows the highest average marginal tax rate. It averaged 57%. And in fact, during World War II and the time thereafter, it reached 90%. And the reality is, the way we see it is, with the amount of debt we now have on the balance sheet, with the growing income inequality, it's very likely, in our opinion, that highest marginal tax rate of 37% is likely, very likely to go higher over the next 4, 8, 12 plus years. It's almost seems inevitable based on the amount of debt we now have on our balance sheet. And this is a big reason, from a planning standpoint, we're working with many of you and discussing with you the prospect of doing Roth IRA conversions. To the extent you have not yet started Social Security, you're not yet taking required minimum distributions, it's a great opportunity to convert some money that would otherwise be taxed at a fairly high marginal rate, pay a lower tax rate on that, then all the future growth can grow tax-free. So here's, I think, one of the most impactful slides that we're going to go through, and it goes a lot to how we construct portfolios. And this slide actually looks at all of the bear markets and subsequent recoveries going back to World War II. And a bear market, for those of you who forget from your economics class, a bear market is a peak to trough decline in stocks of 20% or more. Okay, so we actually are in a bear market because the COVID sell-off was a sell-off of 34%. What you see here is all the different bear markets that have been experienced since World War II, and the average decline, the average bear market decline, has been 35.7%. The average time to recover, meaning to get back to where you started. So if you had $100, declined by 35.7%, to get back to $100, it took about 2.2 years from the bottom. If you look at that dotted line right in the middle, kind of in the middle left-hand side of the slide, you can actually see the most recent sell-off data point there. It's a very, very steep sell-off, and that is the 34% that we lost in the market in a period of about a month. And of course, we haven't yet recovered to the previous peak. But it's just very important to know that when those markets are in free fall, it's very easy to kind of lose sight of the long-term, the long-term perspective and what your money is there designed to do. Stocks don't fall 20, 30% in a vacuum. Generally, the reason that's happening is because something went very wrong. And so a lot of times people think, oh, if stocks are down 20, 30%, I'll buy more. Every conversation we've had with clients, or almost every conversation, would be the opposite. It's the concern, well, what if it drops 30, 40, or 50%? But nevertheless, this is a good data point to actually show the recovery period, what the average recovery period is. We suspect this recovery period, because of the actions of the Fed and Congress, will likely be quicker than the 2 years, 2 month average. So here is a look at the performance of various portfolios, ranging from a 100% stock portfolio all the way down to a 100% bond portfolio over the period from before the global financial crisis to today. And the reason this is, I think, the most important slide we're going to look at is because during the global financial crisis, from October 2007 to the market bottom on March 2009, the S&P 500 declined the S&P 500 declined by 57%. So just to put that in perspective, we declined 34% during COVID. That would be like declining an additional 23% on top of what we had lost. So a much steeper decline. But here's the perspective. If you were invested in a 100% stock portfolio in October 2007, so right, we go back to the beginning of this chart here, you would have bottomed in March of 2009. In order for you to get back to those the pre-crisis levels, your stock portfolio would have broken even in November of 2012. So approximately 5 years after the previous peak, you would have been back to where you started, which sounds pretty abysmal, and it is. But the most important point to realize is now let's fast forward from that 5-year time period, November 2012, where you broke even, to today. Including the declines we've experienced, your portfolio would be up 157%. So to put that in dollar terms, if you had invested $100 back in October 2007, before the crisis, it would have gone all the way down to $43, right? And if you held on, you would have recovered by November 2012, and today it would be worth about $254. So that just shows you that your largest margin of safety, and this is something we continue to talk about, and we're going to send everyone a video called the bucket approach for exactly this reason, is that your best margin of safety is your time horizon. Okay, because you can see here, this is going back 13 years. For 5 years, right, you hadn't made any money in stocks, essentially. But if you were to then extend on another 7, 8 years, you now not only had recovered, but you were up significantly from that point. Conversely, bonds in the short term, they actually didn't have a negative year. So you were in the green immediately, starting by the end of 2008. But if you fast forward to 2020, it's still positive return, but it's 72% that you would have made versus 157%. So the volatility that you experience is a big reason why your returns are higher, right? That's the price you pay for a higher return. And in between the blue and red lines, you see the kind of the goldish yellow and the green line. The green line represents a 60% stock, 40% bond portfolio. And you can see that recovered far quicker than the all stock portfolio. A 60-40 portfolio had broken even by October 2011, and a 40% stock, 60% bond portfolio had broken even by February of 2010. So sometimes it's helpful, in our opinion, to give bear markets a little bit of historical context and dimensions, right? How steep is it typically? What's my recovery time period? How long is it going to take to get back? And while we can't say, what's going to happen this time, if you look back at all these different periods in history, it has recovered, and here's kind of the general range. And this was a more severe market decline than what we've experienced thus far, but by a fair amount, the 2008, 2009 market decline. So what this shows is the S&P 500 annual calendar returns. Those are shown in the gray bars going back to 1980, so about 40 years of data. The red dots with the negatives under them show you the intra-year drops each of those calendar years. So what this is really saying is volatility is completely normal. Pullbacks are a very normal part of the market. And despite that, let's look at 1980 as an example. Let's go back to you invested $100. Well, at one point during that year, that $100 dropped to about $83. And yet, if you went to bed on January 1st and woke up on December 31st of 1980, your $100 would be worth $126. So this is not the first time. In fact, I believe about 25% of the years between 1980 and 2020, you had drops of 20% or more, intra-year drops of 20% or more. And most noteworthy is the average, if you look at the top of the slide, the average intra-year drop of the S&P 500 is 13.8% per year. It's a pretty significant decline. And yet the average return per year from 1980 through today is 8.9%. 8.9% return per year means that you're doubling your money approximately every 8 years. So let that sit, doubling your money approximately every 8 years. Now, again, this would be a 100% stock portfolio, but there are opportunities every single year along this way, including this year, to say, enough is enough, I've had it, right? Because seeing your portfolio drop by 17, 18%, year after year, and yet finishing higher can be a very stressful experience, because again, those things don't just happen in a vacuum. Usually things are going wrong, right? There's a trade war, there's a war, there's a recession, there's coronavirus, there's always some event happening. And yet if you look at the big picture, the market continues to trudge higher over time. So what we're looking at here is bull and bear market cycles, and I think this marries well with the quote that we started with at the beginning of the webinar, which is that people don't take notice of the gradual compounding and growth and progression that happens in the stock market and in the economy, but people can't possibly ignore when things go wrong, right? The sell-offs, the periods of panic. So going back to the 1950s, you can see those kind of orange shaded periods are recessions and bear markets, where you had a market decline of 20% or more. And then what you see in the blue is the period of expansion you had. Not only are the expansions far more greater in terms of duration, but look at the returns that you're getting during these expansions. I mean, let's just look most recently. The returns from the bottom of 2009 through the peak of 2020 was 400% return in stocks. So, I don't remember many people talking year after year about this incredible run we've had and the progress rate. In fact, most people talked in 2012. There was the fiscal cliff scare. 2011, the US was downgraded from AAA to AA. 2015, you had the oil crash. 2016, you had the election and all the implications of that. And now you have coronavirus. And yet we're still sitting 10% from all-time highs. So it's pretty amazing. It doesn't feel real, but that's just the nature of how these things have worked historically. So this last slide, time, diversification, the volatility of returns, I think really goes to highlighting the longer your time frame, the greater the odds are stacked in your favor. An analogy that we've talked about internally is when, a casino has slight odds when it comes to their advantage over the player, right? It might be in blackjack, they have a 51% advantage, 51 to 49, and some other games it might be a little bit higher, but it's not like it's 90% to 10%. But the reason the casinos stay in business and people don't when they gamble is because over long periods of time, the casino is going to make money because they have that slight edge. But it can take many different iterations before they start, seeing the advantage show up in their bank account. And it's very similar in the stock market, except as an investor, it's more like you're the casino. The odds are more heavily stacked in your favor. And here's what we mean by that. From 1950 to 2019, here are if you look on the left, the 1 year, the 3 bars on the left-hand side, and the 1 year, it's pretty volatile, right? I mean, if you're invested in a 100% stock portfolio, that's the green bar. Over a 1 year time frame, your returns would have ranged from negative 39% to positive 40% between 1950 and 2019. Pretty wide possibility. But if we just track that, if you look over 5-year rolling periods, so the next kind of 3 bars over, let's just track with the 100% stocks green lines. Now, the worst 5-year rolling period, right? So that's 1950 to 1955, 51 to 56, 52 to 57, a lot of data sets. The worst return you had over a 5-year rolling period was negative 3% per year. The best return you would have had is 28% per year. Now let's go forward 10 years, 10-year rolling periods. Now the worst thing you would have seen is negative 1% per year. The best is 19% per year. But the most telling is the 20-year rolling period. over every 20-year rolling period between 1950 and 2019, the worst return you would have had in stocks would be 6% per year. Per year. That's your money doubling about every 12 years. The best returning annualized return you would have had is 17% per year. And then if we go to the blue bar, that's a pure bond portfolio, right? So a narrower range of outcomes, but a lower return over the long term. And then a 50-50 portfolio actually shows starting in the 5-year rolling periods, you never had a negative annualized return over any of those time periods, and then it just gets better as you go further out. So the longer your time frame, the better your odds are of making money, and it actually increases significantly as you go to longer and longer time periods. So it looks like there are some questions. Let's see here. And Jamie and Jeff, feel free to hop on if you want to answer any of these. I haven't seen them yet.
Hey Josh, we're answering a number of the questions. If you, I don't know if you were able to put up the polls or not.
No, I can do that. So it looks like there are some questions coming in. You want me to do the polls just and then we can answer the questions? Jamie?
Sure. Yeah.
Okay. So we did this to try to kind of have some fun. How many stocks that were in the original Dow Jones still remain as of today? If you could click on it, submit your answers. Data's coming in. Look at this. Changing. Very good. So it's pretty evenly dispersed. So 23% of you, 25, all right, it's changing. I'll let it. I think we're about good there. So 24% of you said no stocks that were in the original Dow Jones still remain. 27% of you said 1, 39% said 3 still remain, and 9% said 5. The actual answer is 0. So again, a further indication of how much the economy has changed. Because Jeff, Jamie, when we looked at some of the individual companies in the original Dow Jones, what were some of the names? It was like you had a rubber company, a tobacco company, right? Very kind of representative of the industries at that time.
Yeah, mainly oil, gas, some early manufacturing.
Okay, very good. So here are the results. And then here's another question that we really like. And this may surprise you, and this is an indication of how much the economy has changed as well. What percentage of Apple employees are employed in the United States? Wow. Now you know we're trying to trick you.
And you can share the results, Josh, so everybody can see.
All right, I thought I had, sorry. We'll be honest, this one we actually looked up as well. So actually the answer is 58% of Apple employees are employed in the United States, but that's actually still surprising, right? Because that's considered kind of an iconic American company, and you have almost half of the employees outside the United States. So pretty interesting, and I will share those results here. Can you see that?
Yeah, we can see that.
Great.
We had a question, Josh, about from a client actually. Would they be able to share this presentation with others?
Absolutely, we encourage it.
Meaning that we'll load. We are actually recording the presentation. We'll load it onto YouTube, and we'll send everyone who participated a link to that YouTube video shortly after the presentation.
Are there any other questions that came in?
Yeah, we've been able to answer most of them personally. There's one, considering the liquidity being supplied, should we be concerned about inflation?
Right.
And there's a shorter question: does the Apple employees include the manufacturing employees?
Okay. So yeah, I think to the question on considering liquidity being supplied, that is the danger, is that you have kind of runaway inflation because you've flooded the system with too much money. And I think a lot of us, this is all of this is unprecedented. And Jeff, I would appreciate your kind of thoughts on this if you're okay talking about it a little bit. But all of these actions are unprecedented. I remember we were at the Berkshire Hathaway conference in 2013, and Warren Buffett, who's pretty smart guy, said that he would be surprised if there wasn't inflation within the next 10 years. And of course, inflation has remained very, very tame despite QE1, QE2, QE3, the huge expansion in the balance sheet. We have not seen inflation yet. However, it's something we are keeping an eye on, and we'd be surprised in light of how much stimulus has been injected into the economy if there's not some sort of a byproduct. I mean, the biggest concern would be somehow the dollar in time, kind of the world loses faith in the dollar as the reserve currency of the world, and that could have all sorts of implications. But as of right now, inflation continues to remain tame, but it's something we're going to keep our eye on as the economy, if it does reopen, faster than expected, we could certainly see inflation. But the Fed has said they're going to keep interest rates at zero for multiple years, so they do not see inflation as being a threat. Jeff?
Yeah, I would just say it's really just a two-part question. The liquidity being provided by the Fed is part A, and I think you already have seen a reflation trade, right? I mean, corporate bonds are up from their lows. They got really hammered, and they're up about 30% off their lows. And we all know what stocks have done since the lows on March 24th. So they're up about 35% as well. So the liquidity that was provided by the Fed is kind of liquefied a lot of the markets that it kind of seized up, and corporate bonds, municipal bonds, et cetera. As far as the liquidity on the fiscal side, like Josh said, we really haven't seen inflation expectations pick up. There is a market barometer for looking at that using inflation protected securities. And the market's kind of looking at the data that's coming out and saying about 1.5% is what we're looking at in terms of inflation. Now, that may not seem high, and it's certainly not in nominal terms. But the measures that were taken through stimulus packages and whatnot, we don't know what inflation or deflation would have been had they not done this. And so while the top line inflation numbers isn't necessarily anything crazy, like a high single digit or low double digit number, we can certainly be assured that it's probably higher than it would have been had no stimulus been provided. And if we know anything from the Bernanke chair, his history was all about understanding what happened during the Great Depression and ensuring that deflation would not happen in the United States. And so we think central bankers have across the world have kind of taken a page out of that book and understood the severity of a severe deflationary environment and kind of taken any measures that are in their toolbox to kind of prevent something like that from happening. So yes, we do think inflation is going to happen. It's probably not going to be something that we see kind of a 10, 12% type of inflation number. We're probably still kind of, given demographics and whatnot, probably in the low single digits. So that would be my response.
Amy, you good there?
Yeah, I'm answering a lot of the questions that are coming in.
So the question, does Apple employees include manufacturing employees? Yes, to the extent they're employed directly by Apple, but to the extent Apple, contracts things out and kind of the Apple ecosystem, there's far more employees than what we're accounting for there. Do we see a second round of stimulus coming anytime soon? I mean, yes, I would say yes. And what do we expect for the market the rest of the year? Very high levels of volatility, because so much of what's happening and driving the market up is based on what the Fed's doing, how they're injecting money in the economy. And so as the kind of the liquidity shuts off and then starts back up again, we think we're going to see very violent kind of volatility to the upside and downside throughout the rest of the year. But the Fed and Congress, especially being election year, there's a higher floor, I think, set into stock prices, which is exactly their intention, compared to kind of previous years. You're just seeing very, very aggressive action on the part of the Fed in particular. So, I mean, that's setting a higher floor than you might normally expect in stocks, but you're still, we think, going to have a lot of volatility, because at the end of the day, as long as there's not a vaccine that's administered to people throughout the world, that's still driving the main storyline. I'm just reading down these questions. We can just, and if Jamie, Jeff, like something you want to add, just jump in. I'm just trying to go down the questions so we can expand the conversation here.
Yeah, in terms of a second round of stimulus, we're going to see the kind of extended or enhanced unemployment benefits, the PPP stuff, start to roll off here in the next, 4 to 8 weeks. And there's been talk about kind of extending those or kind of including some sort of infrastructure package. So those are, I think everybody's kind of just trying to get a sense, but our feeling is that it's probably going to happen.
There's a good question here about kind of how, and we do think that this is happening, but the kind of the acceleration of the sector rotation away from finance, banking and energy towards more healthcare technology. And yeah, I mean, I think we've done that in the portfolios, has been conscious of trying to avoid, sectors, especially energy, that are, in secular decline. And, with the passage of the CARES Act, there's legislation, they're talking about the requirement of utilities and different companies to be, carbon neutral by 2050. So you can think maybe this is a fad, but our opinion is actually kind of the environment, social governance, the ESG movement, the cleaner, better, cleaner investing movement, that is here to stay. And in fact, I saw this morning on CNBC, Netflix came out and said they are putting 2% of their cash, starting with $100 million, investing it in minority communities, Black communities. They're investing a significant amount of money into historically Black colleges. So you see all these companies pulling away from Facebook. So we think that trend is here, and a lot of these tech companies are trying to lead the way in terms of reframing how people think about investing and the role companies can play going forward. And coronavirus has been, I think, the impetus for that change.
There's a question on, have we started planning for the Biden presidency from an investment standpoint? And I would say not at this point in time, but we'll probably take a closer look at it in the third quarter. We still have a long time between now and November. Anything can happen, but we don't want to make decisions that change our investment structure before that time. Generally, we make minor changes on a quarter-to-quarter basis, looking to areas that may benefit, whether it's stimulus spending, whether it's a change in how we live our lives because of COVID-19, or whether it's, because we expect a change in administration. We'll make those changes, but we usually wait until we're closer to the time period that a change may actually occur.
So question, I see one more question. How much of future returns are being pulled forward by Fed action now? Is this a valid concern that should it could result in more muted returns for the next several years. It's a good question. I mean, I think yes, that is a possibility, but I also think that it's easy to underestimate the type of innovation and productivity enhancements that occur during times of crisis. And I'm not sure that that is reflected. So certainly lower interest rates, stimulus that the Fed's doing I think has resulted in a much more significant recovery and faster recovery in the markets than we've seen previously, to the extent that that's pulling returns forward that are going to happen over the next 2-3 years, possibly, but I think that the level of innovation and what the world's going to look like then will look very different. More questions coming in. Go ahead, Jeff.
Some of these, like, I'm answering as we go through, and I know Jeff is, and then some we may have to answer the call because we'll have more questions than we have time.
Yeah, I mean, we're trying to make it so everyone benefits to the extent we like. We think a question can help people more broadly. But if you want to, we're going to have a recording of this. If you want the slides, we can send them to you. If someone has individual questions, our emails are very easy. Josh at 4J Wealth, Jeff at 4J Wealth, Jamie at 4J Wealth, Jennifer at 4J Wealth. So we're available. We're happy to engage anyone who wants to individually on any of these things specifically. But the point is here just to provide some perspective. We're living through unprecedented and historic times, which is the reason why we're doing this webinar. We have never done this before, so just an example of how much things have changed. And we're going to continue to do these webinars on an ongoing basis. And if you have suggestions for what you want to hear about, something that'll be relevant to you, we're more than happy to try to make a webinar out of it. So I think that's it for now. Jamie, Jeff, any closing thoughts, additional questions you think we should address?
No, I'd like to thank everybody for attending, and to let you know that for some that we know there are some issues with logging in the beginning. We'll work on those, but we will post the full webinar to a YouTube channel that we have, and we'll send out a link for that. And in the future, if you have family members, colleagues, people who you think could benefit, please share the link. This is an open webinar. It's not just for clients, and so we'd love to have as many people attend that can benefit from it.
Great. Bye-bye. We'll see you next month or earlier.
Thanks, everyone.
Have a happy 4th.
Happy 4th.